The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. There could be more house price pain on the way. A top analyst is predicting prices may not bottom out for another year.
Probably what we're seeing is a slower fall towards that end, and maybe calendar 24 is going to be another softer sort of year.
And stocks are stuck in a catch-22, why stock selection is more important than ever.
The markets are in a bit of a dilemma from which is difficult to escape.
It's Monday the 15th of May and you're watching Markets with Madison. It's no secret that house prices are sliding. Our national median house price is down 15.7% from its peak in November 2021. That's if you go off data from the Real Estate Institute. Some economists say it's plateauing, but the investment firm Jarden isn't convinced. It's predicting prices may not find a floor for another 12 months and will fall peak to trough by still around 26% in total. Well, the man who did the numbers is Grant Swanepoel. Hey Grant, good to see you.
You too, Maddie.
What makes you think that there's more house price pain to come?
Well, the market's starting to look at Australia and seeing that their house pricing has started to find a bottom, and then they're extrapolating that into our market. And what they forget is that the Australian market, first of all, is about 80% of their mortgages is on floating rates, while about 90% of ours is on fixed rates. So while both markets have raised their mortgage rates quite materially over the last 12 to 18 months, New Zealand has the situation where these mortgage rates move slower into our economy than what it does in Australia. So we've still got about 6 to 9 months of these mortgage rate increases to filter in and hurt house prices. But beyond that, Australia also has had a big growth in their net immigration. So they started about 9 months before we started opening the gates again. So those immigrants have come and pushed up the demand on rentals, and rental yields in Australia have jumped back up to 4% where they were pre the COVID lockdowns, where New Zealand also about 4% pre the lockdowns is now sitting at 3.6%, so much lower rental yields for investors' appetite. And that's because Australia has been raising rentals by 15% of the last 18 months, while our last 6 months, we've only seen 2% rise in our rentals. So there's still downward pressure on our house pricing due to a lagged effect. So there's probably 6 to 9 months of difficulty still ahead of us. We're going to see a lot of volatility all the way through to 6 to 9 months' time, and then hopefully we start to see stabilizing of our house price market.
So when do you expect house prices to find a floor? Will that be an extra lag on top of that 6 to 9 months potentially?
That is always a difficult one to answer because, housing, you've got anchoring. Yesterday's price is what we want to get today. We're not willing to let our houses go. So we could hold out, and instead of selling a house in 40 days, we sell it in 80 or 120 days. So house prices have downward pressure on them. How far they fall, it depends on how easy the market's willing to give up on selling a property. And if it does hold out on dropping prices, all that means is you're probably going to get a soft downward push on the prices, but they stay at that level for a lot longer, so 2 to 3 years, instead of having a situation where you lose maybe 1% per month for the next 6 to 8 months, and then we get a stabilization and we return to growth in the house price market. So the answer is a long-winded one to say there's at least 6 to 9 months of downward pressure still on house prices.
And how much pressure in a percentage drop could we see from peak to trough? I know you had a pretty big previous forecast out there. Are you sticking to it?
The banks have softened that a little bit, and that's probably because you're seeing the market trying to stop the fall. And also, as we look across the ditch, we see that their house prices have stabilized. We think, oh, maybe ours should stabilize now. So it's really up to you how much you're willing to give up on your current valuation in order to get rid of your house to see how much is going to fall. So we were predicting around about 24-26% peak to trough. I don't change that too much. I think maybe the bottom end of that is where we're heading towards, but it just stays lower for longer. So there's still 6 to 8% downside from where we are currently.
And with that earlier forecast on that potentially 26% drop, peak to trough, what was the initial timeline that you had for that to find a floor, and has this updated that?
Well, we were thinking about December this year, we find a floor, and probably what we're seeing is a slower fall towards that end, and maybe calendar 24 is going to be another softer sort of year, maybe not a down year, but no tick upwards, particularly with inflation running currently at almost 7%. You're going to get real declines, if not nominal declines, into 24.
The median house price, according to the Real Estate Institute, fell by 0.5% in the month of April, and the month before that it was by 0.8%. So some economists say that suggests it could be plateauing. Are you not convinced by that, or do you think this size of fall will just continue for a bit longer?
It's not a homogenous house market. So every month, it's not like the same house is selling over and over again. So we're going to get volatility in the mix. And if you did see a 0.8 going to 0.5, yeah, you think there's a bit of a deceleration going on. But next month it could be 0.7 or 0.9, and the following month it could be a positive number. But just in aggregate, over the next 6 to 8 months, I think it's still going to fall around about 0.5 to 0.8% per month.
Now, Grant, I know that the reason that you actually crunched all of this numbers and did all of this hard work was because you wanted to know the impact that it would have on a company like Fletcher Building, which is a stock that you cover very heavily. So what impact could this have on Fletcher Building?
House prices play a big role in how much building activity starts each year. And with house price falling, you'd normally see the building rate slow down quite materially. However, we have had a massive build-up in building consent inventory. And what we're seeing currently, and actually surprised us when we looked at what's going on in Auckland, you can actually pick up the Auckland houses completed. And when you look at how many houses were completed through to March, it's actually picked up over the last 3 months. So it means that building activity is actually still pretty strong. So even though we think that there is a natural demand slowdown into FY24 for Fletcher Building, they do have a bit of the current momentum that's going to roll into that year. And where we see that is probably one of their softer years, they're probably going to have a soft landing, softer than we were previously expecting. So house prices, negative impact, but building activity at the moment is still strong.
Some silver lining. Thanks so much for your time, Grant. Appreciate it.
Thanks, Maddie.
Tech stocks are carrying the whole market this year. But what about all the other sectors? Harbour Asset Management's Shane Solly says it's time to get selective with your stock picking. Hey, Shane, thanks for joining us.
Yeah, kia ora, Maddie.
Shane, you're always on the side of active management, but what is it about this environment that we're in and the mood of markets right now that makes you think that this is especially not a good time to just throw money at a fund?
Yeah, look, I think what we're talking about a lot to people is this catch-22, that markets are in a bit of a dilemma from which there's a difficult escape. This is mutually conflicting or competing conditions. What we're talking about is if inflation remains elevated, central banks, they have to hold rates higher for longer. And then, of course, that puts pressure on capital market valuations. On the other side, if the economy slows quickly, then in response to these higher rates, then we actually see economic forecasts fall, earnings forecasts fall. So we think people need to be really selective in terms of dealing with the conflicting forces. Markets are likely to stay pretty choppy as these go head to head.
So how can we select good stocks in this environment and effectively offset that catch-22, so you call it?
Yeah, look, we think you've got to go back to fundamentals of targeting industries and companies that actually benefit from structural tailwinds. These are things like healthcare, for example. Unfortunately, in good times and bad, people still get sick. There's technology changes coming through in that space that are driving productivity, driving demand. Things that actually keep on going regardless of what's happening with the cyclical activity. The recovery in China is something we need to keep an eye on. There's certainly some tailwinds still coming through there. So those sort of things that are more of a structural tailwind, less dependent on near-term activity in our markets, our economy, I should say.
But earnings out of the US just recently were pretty solid, weren't they? So doesn't that suggest to you that we don't need to be positioned so defensively?
Yeah, actually, you're bang on. US and even European earnings were better than expected. But if we unpick that and go what's behind it, it was a small number of quite large growth businesses that really drove that earnings beat. In fact, if you break down the US S&P 500, it was the top 100 stocks that did most of the earnings beat. And if you break it down again, it was pretty much the top 10 stocks. And that was all about who's got pricing power, who can keep growing through a period of slower economic growth. So pretty picky, and that's where we're focusing, just to focus in on those businesses that can keep growing.
$1 million question, I know, but I hope you can attempt to answer it anyway. How long could this cycle last, Shane? When can earnings just hurry up and get worse so they can finally improve again?
Well, one of the things that I think, I'm an optimist. The US central bank, other central banks have moved a long way. We've seen between 4 to 5% interest rate increases in a very short period of time, and we're seeing a response starting to come through in economies, particularly inflation. So we could be at the point where central banks go on pause, they stop increasing interest rates. And pause is not a bad thing for capital markets. We can actually see government bond yields back a little bit. Stocks can do okay historically when we get a pause between rate stop going up and cuts. Stocks do pretty well. But again, you've got to be careful. In our view, certainly within a shared market point of view, it's about that growth and inflation lower. And if US federal pause means you've got to go to defensive growth, quality companies, businesses that can tough it out in a slower economic environment. So a pause by central banks, that might actually give a little bit of gas back to capital markets.
Are you expecting to see any downgrades going into our reporting season kicking off soon, or possibly out of Australia or any other markets?
Yeah, so interesting phenomena if we go back to what we're seeing globally in the reporting season. In some cases, companies just meeting expectations or even missing the boat a little bit. We saw stock prices go up because it wasn't as bad as what markets had expected. In recent weeks in Australia, we've had quite a few quarterly updates. And what we've seen is the companies actually see downgrades to their forecasts from their analysts. Stock prices have gone up. It's not as bad. Now, we come into the reporting season this week here in New Zealand. Pretty busy 2 weeks. We've got 20 plus companies reporting. There'll be plenty of noise, plenty of interesting things to get through. We've actually seen the rate of earnings downgrades slow going into this. Still downgrades, still cuts, but not as bad. So we're obviously looking for operating leverage to come out. So we're most focused on some of the more economic sensitive cyclical companies where the rate of activity at the top line, revenue, is slowing, reducing operating leverage. So we think we're going to be pretty selective in that mix.
And just quickly touching on exactly how you're positioned, I've seen your recent shorts and it includes a big banking stock. Just specifically on that, why are you shorting the financial system at the moment?
Yeah, so we've got a long short fund. It's been going for several years now. It's actually delivered pretty good returns. One of the stocks at the moment is a bank stock, an Australian bank stock. And there's obviously 4 in Australia, so 4 of the large stocks. You can work out which it is in due course. But really, we've been focusing on net interest margins. So this is the differential between what a bank borrows at, what they lend at, and the rate of growth in that lending book. What we've seen in the last few weeks is all the large banks report in Australia, and they have pointed to the slowing net interest margin, and that's all about where economy is going. They're seeing some pace come out. So very much our research has shown us that the bank stocks had not allowed for that slowing in net interest margin. Yes, they've corrected a bit. Maybe there's more to go. So we're happy to remain short. That means we've got a negative position in one of the large banks in Australia.
Well, it's a busy couple of weeks ahead, so I'll let you get to it, Shane. Really appreciate your time. Nice to chat.
Thanks, Maddie. Nice to see you.
All right, it's a big week this week. As Shane mentioned, reporting season kicks off. We have property firms Goodman and Argosy both with full year results this week, and Ryman Healthcare and My Food Bag both later this week too. Obviously, Thursday is budget day. I'll be hosting our live stream on the day at 2 p.m, so please come and keep me company. Until then, go and put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.